Intermediate Accounting, Chapter 10, Property, Plant, and Equipment, Accounting Model Basics. Chapter 10, Property, Plant, and Equipment, Accounting Model Basics, 1 of 2. After studying this chapter, you should be able to 1. Identify the business importance and characteristics of property, plant, and equipment, and explain the recognition criteria. 2. Identify the costs to include in the measurement of property, plant, and equipment at acquisition. 3. Determine asset cost when the transaction has delayed payment terms or is a lump sum purchase, a non-monetary exchange, or a contributed asset. Chapter 10, Property, Plant, and Equipment, Accounting Model Basics, 2 of 2. 4. Identify the costs included in specific types of property, plant, and equipment. 5. Understand and apply the cost model, the revaluation model using the asset adjustment method and the fair value model. 6. Explain and apply the accounting treatment for costs incurred after acquisition. 7. Identify the differences in accounting between IFRS and ASPE and what changes are expected in the near future. Property, Plant, and Equipment, Accounting Model Basics. Definition and recognition of property, plant, and equipment. Property, plant, and equipment business perspective. Property, plant, and equipment characteristics. Cost elements. Self-constructed assets. Borrowing costs. Dismantling and restoration costs. Measurement of cost. Cash discounts not taken. Deferred payment terms. Lump sum purchases. Non-monetary exchanges, contributed assets and government grants, land, buildings, leasehold improvements, equipment, investment property, natural resource properties, biological assets, measurement after acquisition, cost and revaluation models, fair value model, additions, replacements, major overhauls and inspections, rearrangement and reinstallation, repairs. IFRS ASPE comparison. A comparison of IFRS and ASPE looking ahead. Property, plant, and equipment business perspective. Long-lived assets include physical assets such as property, plant, and equipment, non-physical assets such as patents. Long-lived assets are important to businesses. These assets are used to produce goods and/or provide services. They represent the enterprise's potential for future cash flows. To assess potential, users need solid understanding of the investment in long-term productive assets, information about how the investments have changed in the period, information about the accounting policies applied to the assets. Governments have the same issues with long-lived assets as businesses. Property, plant, and equipment characteristics 1 of 4. Property, plant, and equipment includes long-term assets like office, factory, and warehouse buildings, investment property, equipment, machinery, furniture, and tools, mineral resource properties. PP&E, also called tangible capital assets, plant assets, fixed assets. Amortization, a general term for allocation of the cost of any long-lived asset to different accounting periods, but specifically depreciation for property, plant, and equipment, depletion for mineral resource properties, amortization for intangibles. Property, plant, and equipment characteristics 2 of 4. Property, plant, and equipment are defined under both IFRS and ASPE as assets that are held for use in production of goods and services, for rent, or for administrative purposes, used over more than one accounting period, tangible. Items that have multiple uses, are used regularly, and replaced within the accounting period would be classified as inventory. Item used only with a specific capital asset and are useful over more than one accounting period are classified as property, plant, and equipment. Biological assets. Under ASPE, apply same principles as for property, plant, and equipment. Under IFRS, apply specific standards for biological assets, agricultural produce, and bearer plants. Property, plant, and equipment characteristics 3 of 4. Recognition criteria for capitalization. Probable that a future economic benefits from the asset will flow to the entity. Cost can be measured reliably. Assets that do not have future economic benefits but are necessary to obtain benefits from related assets can be capitalized as property, plant, and equipment, such as pollution reduction equipment. Costs that are incurred but do not meet the criteria, such as repairs and ongoing maintenance, are expenses. Property, plant, and equipment characteristics 4 of 4. Componentization. Components of a single asset, for example, roof of a building, recognized separately only if they make up a relatively significant portion of the asset's total cost. If the components have different useful lives and/or different pattern of delivering economic benefits, different depreciation. The significance of the items and the similarity of their life and use are considerations in deciding whether to aggregate smaller items into a single larger asset. Componentization addressed under both ASPE and IFRS, with the discussion and application under IFRS more developed. Property, plant, and equipment cost elements 1 of 2. Capitalized cost of property, plant, and equipment includes all expenditures needed to acquire the asset, purchase price net of discounts and rebates, bring it to its location and to a state where it is ready for use, including delivery, site preparation, installation, assembly, professional fees, etc. Discharge obligations associated with assets' eventual disposal, for example, site restoration. Costs that are not capitalized: initial operating loss, training employees, reorganizing operations, admin and general overhead costs, cost of opening a new facility, introducing a new product, operating in a new location. Property, plant, and equipment cost elements 2 of 2. The general principle of capitalization of costs is the same under IFRS and ASPE, but the application may be different outcomes. Example: a company, after clearing land and while waiting for construction to be completed, generates net income from using the property as a parking lot. Should this net revenue be deducted from the cost of the building or recognized immediately into net income? IFRS: capitalization stops when the asset is in place and ready to use as intended. With ASPE, capitalization stops when an asset is substantially complete and ready for productive use. Under IFRS, cannot be capitalized. The principle of being a necessary cost to acquire and get it in place and to be ready for use is strictly applied. And you would debit cash and credit rent revenue. But under ASPE, any net revenue or expenses generated prior to substantial completion and readiness for use are included in determining the asset's cost. You would debit cash and credit building. Property, plant, and equipment cost elements self-constructed assets. These are assets constructed by the business for use in operations. The cost of self-constructed assets includes direct materials, direct labor, directly attributable overhead, for example, variable manufacturing overhead. Abnormal amounts of wasted inputs and related excess costs should be expensed. Property, plant, and equipment cost elements borrowing costs. Under IFRS, Borrowing costs to finance the cost of acquiring, constructing, or producing assets that take a substantial period of time to get ready and that would otherwise be avoidable are to be capitalized. ASPE allows a choice of capitalizing or expensing such interest costs. Amount of interest capitalized and policy chosen must be disclosed in the notes. Appendix 10A explains how borrowing costs are defined, how to determine which are avoidable, how to determine the amount to capitalize. Property, plant, and equipment cost elements, dismantling and restoration. Asset retirement costs are the costs needed to dismantle and remove an item and restore the site at the end of its useful life. Under both IFRS and ASPE recognition criteria, these costs are added, debited, to the capital cost of the property, plant, and equipment, with a credit to an asset retirement or restoration liability. Because the actual expenditures will not be incurred for a long period of time, the liability is based on the present value of future costs. Category of obligations under IFRS recognizes costs of both legal and constructive obligations, such as when an entity creates an expectation in others through its own actions that will meet this obligation. ASPE recognizes costs associated with the legal obligations only. Category of activities under IFRS, costs include only those related to the acquisition of the asset, not those related to the use of the asset in the production of goods or services, product costs. Under ASPE, costs include both retirement obligations resulting from the acquisition of the asset and its subsequent use in producing inventory, such as the mining of coal. Measurement of cost for non-monetary exchange, 1 of 14. Generally, cost is measured by the amount of cash or cash equivalents paid or the fair value of consideration given up to acquire an asset. The amount of the cash cost may not always be obvious. Common issues when cash is not exchanged at acquisition: 1. Cash discounts not taken. 2. Deferred payment terms. 3. Lump sum purchases. 4. Non-monetary exchanges, share-based payments. 5. Non-monetary exchanges, asset exchanges. 6. Contributed assets and government grants. Measurement of cost for non-monetary exchange, cash discounts not taken, 2 of 14. When cash discounts are offered on the purchase of plant assets, the net of discount method is preferred conceptually. The asset cost is reduced by the discount amount even if the discount is not taken. The discount, if not taken, can be recognized as a financing expense. Other approach: discount should not be deducted unless taken. Simpler approach preferred by companies recognizes that the discount may not be deducted because of unfavorable terms or because taking discount may not be prudent. Measurement of cost for non-monetary exchange, deferred payment terms, 3 of 14. Assets purchased through long-term credit are recorded at the present value of the consideration exchanged, cash price equivalent or fair value. Difference between fair value and the cash paid is recognized as interest. When no interest rate is stated, an appropriate rate is imputed. If cash exchange price is known, it is used as the basis of cost and for identifying the interest element. Interest is expensed during the periods involved. Measurement of cost for non-monetary exchange, deferred payment terms, 4 of 14. Example: Sutter Corporation purchases a specially built robot spray painter for its production line. The company issues a $100,000 5-year non-interest-bearing note to Wrigley Robotics Ltd. For the new equipment when the prevailing market interest rate for obligations of this nature is 10%. Sutter is to pay off the note in 5 $20,000 installments, made at the end of each year. Assume that the fair value of this specially built robot cannot readily be determined. At what amount should Sutter record the equipment purchased? So you would do the present value of the note, and we'd use our financial calculator instead of the table, and you would end up debiting equipment for 75816 and credit notes payable for 75816. The present value of 5 annual payments made at the end of each year at a rate of 10%, the 24184 difference between cash cost of 75816 and amount repaid, 100,000, is the discount or interest on the 75816 borrowed. Measurement of cost for non-monetary exchange lump sum purchases, 5 of 14. Cost of assets acquired at a single lump sum price is the purchase price allocated to assets on the basis of the relative fair market values. Individual fair value is based on the best information available: insurance, replacement cost, tax values, independent appraisal. Example: purchase several assets of a smaller company for a total price of $80,000. Seller's book value: inventory $30,000, land $20,000, building $35,000. Asset fair value: inventory $25,000, land $25,000, building $50,000. So the total of the book value is $85,000 and the asset fair value is $100,000. So you'll just end up prorating over the total cost that you purchased it for of $80,000. So inventory, you would take the fair value of $25,000 and divide that by the total of $100,000. Multiply that by $80,000 and you get $20,000. Same thing with the land, you get $20,000. Building, you get $40,000 for a total of $80,000. The seller's book value is irrelevant. Measurement of cost for non-monetary exchange, share-based payments, 6 of 14. IFRS: when property is acquired by issuing shares, the fair value of the asset received or the fair value of the shares given up is used for the cost of the asset. If the fair value of the asset received cannot be determined readily and the shares given up are actively traded, the market value of publicly traded shares is used. ASPE: the more reliable of the fair value of the goods received or the equity instruments given up is the asset cost. A company purchases land, issues 5,000 no par value common shares to seller. A: land is appraised at 62,000 shares. Shares are not publicly traded, so the cost of the land is 62,000. B: fair value of the land cannot be determined reliably. Shares recently traded at $12, so the cost is 60,000. Measurement of cost for non-monetary exchange, asset exchange, 7 of 14. Monetary assets are money or claims to future cash receipts, such as cash and accounts receivable. Non-monetary assets are assets that are not claims to fixed or determinable cash flows, such as inventory, long-lived assets, equity investments. When non-monetary assets are disposed of and monetary assets are received in exchange, a gain or loss on disposal is recognized in income. When a non-monetary asset is exchanged for another non-monetary asset, what should be the cost of the asset acquired? Should a gain or loss on disposal be recognized for the asset given up? Measurement of cost for non-monetary exchange, asset exchange, 8 of 14. The general principle is that the cost of the asset acquired is determined by the fair value of the assets given up unless the fair value of the asset received can be more reliably measured. The exchange cannot be recorded at fair value if the fair value of either asset cannot be reliably measured. The exchange transaction has to have commercial substance. There has to be a significant change in the company's expected future cash flows and therefore its value. Amount, timing, or risk of new future cash flows is different from those of the cash flows of the asset given up. Entity-specific value of the new asset differs significantly from the value of the asset given up. Measurement of cost for non-monetary exchange, Asset Exchange 9 of 14. Summary of the accounting for asset exchange. Does the exchange meet both criteria? In other words, does it have commercial substance, and can fair values be readily determined? If yes, apply the fair value standard. The cost of assets received equals the fair value of what is given up or what is acquired if more reliably measurable. The difference between carrying amount and fair value of assets given up is recognized in income as a gain or loss. If the criteria is no, then the exception to the fair value standard is used. Cost of assets received equals carrying amount of assets given up. No gain is recognized. Loss is recognized if fair value of assets acquired is less than the carrying amount of the assets given up. When an asset is acquired, it cannot be recognized at more than its fair value. Measurement of cost for non-monetary exchange, Asset Exchange 10 of 14. Examples: commercial substance trade-in. Machine given up, book value $8,000, original cost of $12,000 less $4,000 accumulated depreciation, fair value $6,000. Machine acquired, list price $16,000, trade-in allowance on old machine $9,000, cash paid to seller $7,000. Fair value of assets given up. Amount of cash given up equals list price less trade-in allowance. So that's $16,000 minus $9,000 equals $7,000. Fair value of machine given up, $6,000. Cost of new machine equals fair value of assets given up, $13,000. Because the cash paid is significant relative to the fair value of the total consideration, the change in the configuration of the company's future cash flows justifies a conclusion that the transaction has commercial substance. The journal entry to record this transaction is debit machinery new for $13,000. Debit accumulated depreciation machinery old for $4,000. Debit loss on disposal of machinery for $2,000. Credit machinery old for $12,000. And credit cash for $7,000. Calculation of loss on disposal of used machine is fair value of used machine $6,000, carrying amount of used machine $8,000, loss on disposal of used machine $2,000. Measurement of cost for non-monetary exchange, Asset Exchange 11 of 14. Examples: commercial substance, exchange trucks, cash for land. Assets given up, trucks, carrying amount $42,000, which is cost of $64,000 minus $22,000 accumulated depreciation, fair value $49,000. Asset acquired, land, cash given up $4,000. This exchange has commercial substance because the pattern and timing of cash flows from the investment in land are very different from those of the trucks. In addition, fair values can be determined. Calculation of land's acquisition cost. Cost of land equals fair value of assets given up. The fair value of trucks exchanged is $49,000. The fair value of cash given up is $4,000. The acquisition cost of the land is $53,000. The journal entry to record the exchange is debit land $53,000. Debit accumulated depreciation vehicles for $22,000. Credit vehicles for $64,000. Credit cash for $4,000 and credit gain on disposal of vehicles for $7,000. The gain is the difference between the truck's fair value of $49,000 and their carrying amount of $42,000. Measurement of cost for non-monetary exchange, asset exchange, 12 of 14. Examples: no commercial substance, exchange of similar properties. So we have Westco Ltd. property and Eastco Ltd. property. The building is $520. The accumulated depreciation is $100,000 for a total net carrying amount of $420. The fair value of the Westco property is $615,000 and the cash paid is $30,000. For the East Coast property, the building is $540. The accumulated depreciation is $145 for a total of $395. The fair value is $645,000 and the cash received is $30,000. So Westco Ltd.'s entry would be debit building $450,000, so that's the new building. Debit accumulated depreciation building, that's $100,000 for the old. Credit the old building for $520,000. And then credit cash for $30,000. Now Eastco Ltd. entry would be debit new building for $365,000, debit accumulated depreciation old of $145,000, debit cash for $30,000, and credit building old for $540,000. Because both companies remain in the same economic position after the exchange as before, there is no reason to recognize any change in asset values and a related gain or loss on the exchange. Measurement of cost for non-monetary exchange, contributed assets and government grants, 13 of 14. Non-reciprocal transfers. Transfer of assets in one direction only. Nothing is given in exchange. Donations, gifts, government grants, land, buildings, equipment, or cash to acquire same. Forgiveness of debt. Assets' fair value is used to establish its cost. What account should be credited? Capital approach. Credit contributed surplus, donated capital, only used when the donation is from an owner. Debit, income approach. Credit, net income. Contribution from a non-owner. Measurement of the cost for non-monetary exchange, contributed assets and government grants, 14 of 14. Standards require government assistance to be recognized in income through cost reduction or deferral. Cost reduction method. Asset is carried at a cost less related government assistance. Future depreciation will be less. Net income will be higher each year. Weakness. Reports assets at less than their fair value. Deferral method. Record as a deferred credit and amortized over the life of the asset. Amortized amount is recognized in each year's income. Weakness. Not consistent with conceptual framework. Deferred revenues does not meet the definition of a liability. Extensive disclosure requirements for amounts, terms and conditions, and accounting treatment of government assistance. Measurement of costs associated with specific assets. Land, 1 of 2. Land costs include 1. Purchase price, 2. Closing costs, title, legal, and recording fees. 3. Costs of getting land ready for use, such as removal of old building, clearing, grading, billing, and draining. 4. Assumption of liens or encumbrances, taxes and arrears. 5. Additional improvements with an indefinite life. Sale of salvaged materials reduces cost of land. Special assessments for local, permanent, improvements, for example, pavement, streetlights, are part of land cost. Measurement of costs associated with specific assets, land, 2 of 2. Permanent improvements to the land made by the owner, such as landscaping, are added to the land account. Improvements with limited lives, such as driveways, walkways, fences, and parking lots, are recorded in a separate land improvements account. These costs are separated from land and they are depreciated over their estimated useful lives. Measurement of costs associated with specific assets, buildings. Net costs for the removal of an old building, previously owned and used, to construct a new one are expensed as disposable costs of the old building, increases loss on disposal. If land is purchased with an old building on it that will not be used, any demolition costs less salvage value is charged to land. Under ASPE, the carrying amount of a building being torn down to redevelop rental real estate and net cost for removal can be capitalized as part of the redeveloped property. Measurement of costs associated with specific assets, leasehold improvements. In long-term lease contracts, the lessee may pay for improvements on the leased property, but they become the property of the lessor when the lease expires. Construction of building on leased land, improvements to leased building. These costs are recorded in a separate account called leasehold improvements. Leasehold improvements are depreciated over the lesser of the remaining lease life and the useful life. Measurement of costs associated with specific assets, equipment. Includes delivery equipment, office equipment, factory equipment, machinery, furniture and fixtures, furnishings. Cost of equipment includes all necessary and reasonable costs incurred to get assets ready for its intended use. Includes purchase price, freight and handling charges, insurance while in transit, costs of special foundations, assembly and installation, net cost of trial runs, costs of adjustments to make it operate as intended. Does not include any recoverable tax, for example, GST or HST. Measurement of costs associated with specific assets, investment property. Property that is held to generate rental revenue and or appreciate in value rather than sell as part of ordinary business or use in production, administration, or supplying of goods and services. Includes investment property currently under construction. Issues. If parts can be sold separately, then account for and depreciate separately. If added services expose owner to normal risks of business, might not be considered an investment. Under IFRS and ASPE, cost is determined using the same principles as for property, plant, and equipment. Measurement of costs associated with specific assets, natural resources. Examples: oil and gas resources and mineral deposits. Main characteristics: asset is completely removed or consumed. 2. Asset does not retain original characteristics. Costs to be capitalized relate to 4 activities. 1. Acquisition of properties. 2. Exploration for and evaluation of reserves. 3. Development. 4. Decommissioning and site restoration. Capitalized costs make up the depletion base and are amortized through depletion charge into inventory. Measurement of costs associated with specific assets, biological assets. Examples: fruit trees, grapevines, livestock. Under ASPE, general principles that apply to property, plant, and equipment are also followed for biological assets. A special standard under IFRS, measure at fair value less cost to sell, with changes in value going through income statement. If no reliable fair value, measured at cost less accumulated depreciation and accumulated impairment losses. Measurement after acquisition, 1 of 9. There are 3 different models used to account for property, plant, and equipment subsequent to acquisition. 1 is the cost model, CM. 2, the revaluation model, RM. 3, the fair value model, FVM. Accounting model choices. The GAAP choice of model depends on the type of asset and which standards are being applied. So under ASPE, if you have an investment property or other property, plant, and equipment assets, you use the cost model. Under IFRS, if you have an investment property, you can use the cost model or the fair value model. And under other property, plant, and equipment assets, you can use the cost model or the revaluation model. Measurement after acquisition cost model, 2 of 9. Most widely used model to account for property, plant, and equipment. It's the only model acceptable under ASPE. Measures property, plant, and equipment assets after acquisition at their cost, less accumulated depreciation and any accumulated impairment losses. Measurement after acquisition revaluation model, 3 of 9. Can be used to measure property, plant, and equipment under IFRS, available only for property, plant, and equipment assets whose fair value can be measured reliably. Property, plant, and equipment are carried after acquisition at their fair value at the date of the revaluation, less any subsequent depreciation and any subsequent impairment losses. Not required at every reporting date, but often enough that amount is close to fair value. Depreciation is taken on the revalued amount. Measurement after acquisition, revaluation model, 4 of 9. If the asset's carrying amount is increased, debited, the amount is recorded as a credit to revaluation surplus, or OCI, and an equity account. However, it would be recognized as an increase in profit or loss to the extent it reverses a revaluation decrease for the same asset that was previously recognized in profit or loss. If the asset's carrying amount is decreased, credited, the amount is recorded as a debit to revaluation surplus, OCI, an equity account, to the extent of any credit balance associated with that asset. This account cannot have a debit, that is a negative balance. Any remaining amount is recognized in profit or loss. There can be no net increase in net income from the revaluing of the asset over its life. Disposing of the revaluation surplus OCI account, you have 2 choices. 1, transfer some to retained earnings, the difference between depreciation expense based on the revaluation and the expense based on original cost. 2, remains in revaluation surplus OCI until the asset is retired or disposed of, then transfer the balance to retained earnings. Measurement after acquisition, revaluation model, 5 of 9. There are 2 methods of accounting for the balance in the accumulated depreciation account when revaluing an asset. There's the proportionate approach, where you adjust the asset's carrying amount and its accumulated depreciation. The net balance is the fair value of the asset on the revaluation date. Gives some idea of the age of the asset because the accumulated depreciation continues. An example is shown in Appendix 10B. Or the asset adjustment method. Eliminates the balance in the accumulated depreciation account, writing it off against the asset. The asset is then adjusted to its revalued amount. It's the simpler method, also called the elimination method. Measurement after acquisition, revaluation model example A, 6 of 9. Revaluation asset adjustment method. Building purchased in January 2017. Buildings account $100,000. Company uses revaluation model. Revalues every third year, uses straight line depreciation. Life expectancy is 25 years. There's no residual value. And the fair value on December 31st, 2019 is $90,000. Calculate depreciation for the first 3 years, and revaluation entries considering balance of accumulated depreciation is eliminated. Straight line depreciation, 100,000 minus 0 divided by 25,000 equals 4,000 per year. December 31st after revaluation, 90,000. Carrying amount of building, cost 100,000. Accumulated depreciation, 4,000 times 3 years is 12,000. So the revaluation surplus is 2,000. You would debit accumulated depreciation building for 12,000 and credit building for 12,000 to eliminate the accumulated depreciation. Then you would debit building for 2,000 and credit revaluation surplus OCI for 2,000 to adjust the building's account to fair value. Measurement after acquisition revaluation model example B, 7 of 9. Revaluation asset adjustment method. So everything is the same except for the fair value on December 31st, 2022 is 75,000. So the straight line amortization is 90,000 minus 0 divided by 22 years equals 4091 per year. So December 31st, 2022 after revaluation. So you have 75,000, carrying amount of building, cost 90,000, accumulated depreciation of 4091 times 3 years, it's 12,273, and revaluation surplus is minus 2727. So what you would do is you would debit accumulated depreciation for 12273 and credit buildings for 12273 to eliminate the accumulated depreciation. Then you would debit your revaluation surplus of 2,000, which you previously recognized. You would debit revaluation gain or loss of 727, and you would credit buildings for 2727 to adjust the buildings account to fair value. Measurement after acquisition fair value model 8 of 9. Available as measurement option for investment properties only and under IFRS only. Investment property measured at fair value subsequent to acquisition and until it is disposed of. Changes in value reported in net income during period of change. No depreciation is recognized over assets' life. Note that fair value must be disclosed in financial statements, even if cost model is chosen instead of fair value model. Measurement after acquisition fair value model, example 9 of 9. Mall acquired February 2nd, 2020, 9 out of 10 stores leased, cost is $1 million plus property transfer 40,000 plus legal fees of 3,000, cost of paint for store 2,000, assumed $730,000 mortgage, received 37,000 in damage deposits. Fair value on December 31st, 2020 is 1040000. In 2021 is 1028000. In 2022 is 1100000. So December 31st, 2020, you would debit gain or loss in value of investment property for 3,000 and credit investment property for 3,000. In 2021, you would debit gain or loss in value of investment property of 12,000 and credit investment property for 12,000. and in December 31st, 2022, you would debit investment property for $72,000 and credit gain or loss in value of investment property $72,000. So we prepared the summary journal entry for the purchase and adjustments to fair value entries for the 3 years. So the cost of the investment property originally was the $1,043,000. The painting is repairs and maintenance expense, and there's no depreciation. And that journal entry on February 2nd, 2020 to record the purchase is debit investment property for $1,043,000, debit repairs and maintenance expense for $2,000, credit mortgage payable for $730,000, credit tenant deposits liability for $37,000, and credit cash for $278,000. Costs incurred after acquisition, 1 of 8. If costs incurred achieve greater future benefits, capitalize costs, capital expenditure. If costs maintain a specific level of service, expense costs, revenue expenditure. Major types of expenditures are additions, increase or extension of existing assets, replacements, major overhauls and inspections, substitution of a new part component for an existing asset, and overhauls inspections whether or not physical parts are replaced. Rearrangement and reinstallation, moving an asset from one location to another. Repairs, costs that maintain assets in good operating condition. Costs incurred after acquisition, additions, 2 of 8. Any addition to plant assets is capitalized because a new asset has been acquired. Addition costs are capitalized if they increase the service potential of the existing structure. When changes are made to an existing asset to accommodate acquiring a new one, for example, removing a wall to make room for an addition, theoretically it should be considered a disposal cost of the existing asset. If the change is a minor part of cost of old asset, most companies would keep the carrying amount of the old asset and include the cost of the change, removing a wall, in the cost of the new asset. Costs incurred after acquisition, replacements, major overhauls, and inspections, 3 of 8. Replacements are substitutions of one asset for another that reoccur and may be needed to allow continued use of an asset. Similar to replacements, major overhauls, reconditioning, and inspections also recur and are often needed to keep an asset operational. These costs often meet the requirements for capitalization. They should be added to the carrying amount of the asset. Because it is replacing something that has already been included in the asset's original cost, the original cost and the related accumulated depreciation must be removed from the accounts. If the original cost is known, then it must be estimated. Costs incurred after acquisition, replacements, major overhauls, and inspections, 4 of 8. If the revaluation model is used, the cost of the new asset, component, part, overhaul, is added to the asset's carrying amount. The carrying amount of the replaced asset is removed. A gain or loss can be recognized on the disposal of the replaced asset. Under the fair value model, add the cost of the replacement component or overhaul to the asset. Reassess and adjust the asset to its fair value after the replacement. Costs incurred after acquisition, replacements, major overhauls, and inspections. Example, replacement, 5 of 8. A 15-year-old facility, roof work $26,000, repair and replace shingles $1,000. A. Building, roof is a separate component, cost $16,000, 20-year life, straight line depreciation. Debit repairs and maintenance expense $1,000, debit building, roof new $26,000, credit cash $27,000. B. Building, roof is not a separate component, cost $16,000, 40-year life, straight line depreciation, construction costs doubled since 15 years ago. So we would do the same entry for capitalized for both A and B, but then under A, you would debit accumulated depreciation roof for $12,000, debit loss on disposal of roof $4,000, credit building roof old for $16,000. Under B, you would debit accumulated depreciation for $4,875, debit loss on disposal of roof for $8,125, credit building for $13,000. The estimated cost is $26,000 times 50%. Costs incurred after acquisition, replacements, major overhauls, and inspections. Example, overhaul 6 of 8. Fleet of trucks, truck B14, 2 years old, 63,000. Expected kilometers for life, 300,000. First overhaul cost 9,000 at 50,000 kilometers. Second overhaul cost 11,000 at 92,100 kilometers. A. B14 recognized at 55,000 cost of first overhaul, originally estimate at 8,000. First overhaul. Debit vehicle overhaul 9,000, credit cash 9,000. Debit accumulated depreciation vehicle overhaul 8,000, credit vehicle overhaul 8,000, and we're just using the units of production method for depreciation. Second overhaul, debit vehicle overhaul 11,000, credit cash 11,000. Debit accumulated depreciation vehicle overhaul 7578, debit loss on vehicle overhaul 1422, credit vehicle overhaul for 9,000. B. No separate components recognized initially. One will be recognized after the first full overhaul. First overhaul, debit vehicle overhaul 9,000, credit cash 9,000. Debit accumulated depreciation vehicle overhaul 1364, debit loss on vehicle overhaul 6818, credit vehicle 8182. Second overhaul, debit vehicle overhaul 11,000, credit cash 11,000. Debit accumulated depreciation vehicle overhaul 7578, debit loss on vehicle overhaul 1422, credit vehicle overhaul 9,000. Costs incurred after acquisition, rearrangement, and reinstallation 7 of 8. Accounting treatment for rearrangement and reinstallation costs. 1. If the original installation cost is known, record as a replacement. If the original installation cost is not known, cost is expensed. If the original installation cost is not known and amount is material, capitalize cost under ASPE. Costs incurred after acquisition, repairs 8 of 8. Ordinary repairs are costs that occur regularly to keep an asset in good operating condition. Ordinary repairs are treated as an expense. Examples, replacement of minor parts, repainting, lubricating equipment. A comparison of IFRS and ASPE 1 of 2. Accounting for property, plant, and equipment assets is very similar under both IFRS and ASPE. The principles are similar. IFRS calls for stricter adherence to the principles. IFRS allows use of the revaluation model and the fair value model. Only the cost model is allowed under ASPE. Cost of mineral rights or reserves, e.g. oil, natural gas, are not considered property, plant, and equipment, except for exploration and evaluation, whereas ASPE considered items of property, plant, and equipment. Net revenue or expense derived from an item of property, plant, and equipment prior to its being in place and ready for its intended use is taken into income. ASPE includes it in the asset cost. A comparison of IFRS and ASPE 2 of 2. Under IFRS, capitalization of costs stops when the item is in the location and condition necessary for use, even if it is not being used or not being used to its full capacity. The approach under ASPE is more flexible. Capitalization stops when the asset is substantially complete and ready for use as determined by management. Borrowing costs are capitalized under IFRS. Under ASPE, the entity can capitalize or expense. Cost of legal and constructive obligations related to asset retirement can be capitalized under IFRS, only cost of the legal obligations under ASPE. Looking ahead, we'll eventually replace standard IFRS 6 for exploration and evaluation of minerals. Original was temporary, work to start before 2021. Amendments to IAS 16 issued in June 2017 to prohibit companies from deducting sales proceeds of inventory items produced in the testing phase of an asset from the cost of the property, plant, and equipment item, include in profit or loss. The end.